Hey everyone, welcome back to Corporate Decoder. Today WHLR just filed an 8K announcing a 1-for-4 reverse stock split, and I am seeing some big implications for preferred shareholders. Quick note, this is not financial advice, just my take on public filings for educational purposes. Get ready, because this is more than just a stock split. It is a move that could significantly change how their preferred stock behaves. So, WHLR Real Estate Investment Trust Incorporated is getting ready to do a reverse stock split. This means for every 4 shares of common stock you own, you'll end up with just 1 share. This is happening on the 17th of June 2026, and it is designed to boost their stock price by reducing the number of shares outstanding. They're also lowering the par value of their common stock from 4 cents to 1 cent per S-share. Now, usually when a company does a reverse stock split, you might expect their trading symbol to change. But in this case, WHLR's symbol is staying the same. However, their QSIP number, which is like a unique identifier for their stock, will change to 963025754. They're also saying that there won't be any fractional shares issued. If you were supposed to get a fraction of a share, you'll get cash instead, based on the closing price on the 17th of June 2026. This reverse stock split is expected to take them from having about 21,94353 shares of common stock, outstanding down to roughly 548,588 shares. This kind of move is often done to meet stock exchange listing requirements, or to make the stock appear more attractive to larger investors. Historically, reverse splits, especially for smaller companies, don't always lead to long-term stock price gains, and about half of microcap reverse splits can end in delisting down the road. Important here is how this impacts their convertible notes. The company has these 7.00% subordinated convertible notes, due in 2031. Because of this reverse stock split, the rate at which these notes can be converted into common stock is being adjusted. It is going from about 36.09 shares of common stock for every $25 of principal amount, down to about 9.02 shares for the same principal amount. This means that if you hold these notes, you'll receive fewer shares of common stock when you convert them after the split. Now, for the preferred stockholders, this is where things get really interesting. For their Series B convertible preferred stock, the price at which it can be converted into common stock is going way up. It is increasing from what looks like a very large number per S-share of common stock to an even larger number, meaning 1 share of Series B preferred will only convert into a tiny fraction of a common share, practically zero. The same thing is happening with their Series D cumulative convertible preferred stock. The conversion price is also increasing dramatically, and 1 share of Series D preferred will convert into an even smaller fraction of common stock. This is a significant change that appears to devalue the conversion option for these preferred shareholders, potentially making their preferred stock more like a fixed income instrument, rather than something that can easily convert into appreciating common stock. The company is also including a standard forward-looking statements section. They're saying that things like their anticipation of shares outstanding post-split are based on current expectations, and that actual results could be different due to various risks and uncertainties. They also mention they don't plan to update these statements unless legally required. This filing references exhibits that contain the actual legal documents for these amendments. Exhibit 3.1 is for the First Amendment detailing the reverse stock split itself, and Exhibit 3.2 is for the Second Amendment, which covers the decrease in the par value of the common stock. Finally, we see the signatures with M. Andrew Franklin, the Chief Executive Officer and President, signing off on this report dated the 12th of June 2026. Looking at this filing, the main story is clearly the reverse stock split and its impact, especially on the preferred shareholders. While a reverse split is often a sign of a company trying to improve its stock's appearance, the dramatic reduction in convertibility for the preferred stock is a major point of concern. It suggests the company might be prioritizing maintaining its common stock price or meeting listing requirements over the potential upside for its preferred shareholders through conversion. The drastic adjustment to conversion ratios for both the convertible notes and preferred stock could signal a shift in the company's capital structure strategy away from easy conversion into common equity. The risk I'm watching is how this significantly impacts the attractiveness and value of the preferred stock for its holders, and whether this move actually solves the underlying issues that led to the reverse split in the first place. What I am actually looking for is a clear path to operational improvement that justifies the company's existence beyond stock maneuvers. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video and subscribe for more corporate insights, and join our community in the description.